Hi, my name is Han Seng. I'm the Deputy Chief Investment Officer of UOB Asset Management. The world economy has changed radically from the beginning of the year. It started with optimism that the economy was in the mid-cycle expansion stage, supported by post-COVID reopening and experiencing some inflation largely considered to be transitory. Today, we are grappling with the risk of an impending economic recession with sharply declining consumer sentiment, continued disruption inside and outside China due to China grappling with COVID lockdowns, stickier inflation, tighter financial conditions following 2 rate hikes and quantitative tightening about to begin, compounded by high and potentially longer-term geopolitical risk. In Q3, we expect this uncertainty to continue and possibly even deepen. Our base case expectation is for a soft landing given the strong state of the economy at the start of the year, but the risk of a hard landing remains high. In a soft landing, we expect moderate growth slowdown and stable employment. Our investment approach this coming quarter is to underweight equities with more positive on China and ASEAN, underweight fixed income, keeping duration short and quality high, and overweight cash, commodities and alternative strategies, particularly hedge funds. The market is currently responding to 3 developments: high inflation, which is causing central banks to tighten liquidity to slow down demand, which has the risk of leading to an economic slowdown. This has triggered a regime change from loose liquidity supported by the Fed put to one of tightening liquidity. Increased and even possibly sustained geopolitical risks could accelerate deglobalization trends and aggravate the situation. In this environment, equities will be hurt by valuation compression, decreased availability and increased cost of funding, earnings contraction and margin compression. Fixed income will be hurt by higher credit risk and capital losses. We also expect higher volatility as the market responds to data and news in an environment where there is still significant liquidity. We would recommend investors to consider the following for their portfolios. Firstly, diversify asset allocation beyond equities and bonds to less correlated asset classes such as commodities and alternative strategies. Secondly, look beyond the US for more opportunities. In China, the interest rate policy cycle is different from the rest of the world. Valuation adjustments have occurred and growth prospects could re-accelerate with the loosening of the COVID-0 policy and supportive government policies. ASEAN presents opportunities in commodity exporting countries and possible beneficiaries of supply chain reconfiguration. Energy and commodities provide opportunities where there are significant supply constraints and limited capital expenditure. And to deal with the issues of a deglobalization, look at opportunities which are domestic oriented. Thirdly, investors should exercise increased caution to deal with the increased volatility in the markets on both sides and to broaden the range of risk management tools to include quantitative tools. They should also hold a higher level of cash, which can provide good protection to deal with an environment of tightening liquidity and also give them the resources to take advantage of emerging opportunities. On a more opportunistic note, quite a fair bit of market adjustment has already occurred and the opportunities will be revealing themselves in the coming months. Keep cash in reserve to be ready to take advantage of this opportunity. There will be a time when fortune will favor the brave, but not today. So stand ready and be prepared.